This is Home Buying Basics, where we attempt to simplify the mortgage process for buying a home. I'm Azubuike with Edge Home Finance, and today we're focusing on credit. Continuing our C.I.A. series. Remember, C.I.A. stands for credit, income, and assets. Today we're breaking down how credit scores are calculated and how credit score ranges can give you an idea of what programs you can be eligible for. So let's get into it. All right, everybody, we're talking about credit here. Let's jump right into it. You see, I got my nifty little Google Sheet up. Told you guys I'm a nerd with these Google Sheets, man. Love me some Google Sheets. Helps me stay organized. So I definitely recommend them. But let's jump into it. We're talking about credit here. And the first thing you want to know about credit before we scroll down here, I got these scores that give us an idea of where the score ranges go. We'll talk about that in a little bit. But first, just going over how credit scores are calculated. So the biggest thing is payment history. Man, you just got to make your payments on time. It's real simple. You know, anytime that you're looking for credit, the creditors want to know that they can rely on you to repay as agreed on time. So if you can keep a consistent history of on-time payments, it's crucial to the health of your credit scores. The next biggest thing is balance to limits. That's basically the proportion of balances for your credit cards, credit lines, anything revolving in a HELOC, home equity line of credit. Those kind of accounts basically have the ability to impact your scores the quickest. Even though it's the second largest factor behind payment history, it can actually impact your score the quickest because you can say, for example, if you're maxed out at 100%, and then you pay that down, that's going to have an impact to your score, a healthy impact to your score, quicker than some of these other items. Same way, if you were to have a low balance and all of a sudden it's maxed out, it's going to now help drop your score quicker than any of these other items, except for derogatory items with payment history. So just keep in mind, the biggest thing with your credit cards, revolving accounts, is you want to just keep them under 10% at all times if you can help it. Best way to do that is to make sure that whenever your bill is due for your billing statement for your account, make sure that your payment is made to where 10% of your limit, 10% balance in proportion of your limit, that you have that lower than 10%. And that's ultimately when your payment is due is ultimately when the bureaus are getting the information from the creditors about your account. So not to say that you can never go over 10%, but just the idea is to have it back down under 10% when your bill is due. Everything else here is kind of self-explanatory. You guys can feel free to take a screenshot. I'm going to scroll down here and talk about the scores and the score ranges. And so you can see how it's equivalent to actual program and what it's eligible for. So basically anything over a 760 is considered A++. You're in great shape if you're over 760. See a lot of people in the 800s, but 760 and above basically get treated the same. So you get the best rates for any program. You're eligible for all programs. You're maxed out on all the debt to income ratio requirements. You get the best favorable terms as far as eligibility, as long as you meet all the other requirements for the loans. Once you start going down from 760, it kind of, what I like to call tiers of 20 points, gives you just slightly different changes as far as your loan terms, rates, and things like that. So you can kind of see a general idea of what's going on here. Hopefully there's not too many acronyms here. MI here stands for mortgage insurance rates. Basically anything over 740 gets the best interest rates, but mortgage insurance rates now start to get impacted if you're doing less than 20% down on a conventional, for example. But pretty much anything over 680 is going to qualify for all government programs, FHA, VA, and USDA, and you're also going to get the best rates for those programs. So 680 and above is pretty much A++ as far as interest rates for government programs, unless you're talking about conventional, which conventional rates are going to be impacted, as you see here, when you're going down from 760. Conventional is very sensitive to credit score. So that's the one thing you want to keep in mind. Lenders are going to have to price out accordingly to what your credit score shows as far as the rates that they're offering you. So moving down here, once you get into the 600 ranges, you're flirting with, getting out of the B, C range into the Ds and the D minuses and the Fs. Well, Fs is, in the 500s and below, but you get the point. You basically want to have, the better your score is, the better your eligibility is, the better underwriters are going to look at you as far as how they underwrite your loan. When you get down in these ranges, a lot of times different things will require what they call compensating factors or additional conditions that need to be met for these loans to actually close on. So just keep that all in mind. If you have any questions, feel free to reach out. I'm here to help as always. And feel free to share this if this can be helpful for anyone that you may know. And that's pretty much all I got for now. Hopefully you found it helpful. We'll see you guys on the next video. Thanks for watching. If you found any of the content helpful, please subscribe, hit the notifications icon so that you can be informed of the next video upload. And if you're a borrower looking for a home loan, purchase, or refinance, I'd love the opportunity to work with you. Please give me a call or start the process at applywithzo.com.